Here are 5 IRS traps that hit almost every new retiree in year 1, plus the steps to avoid them completely. For 31 years, she managed her taxes perfectly straight. Each April brought deadlines and paperwork, yet never a problem, never a notice, never an IRS letter once. Then she officially entered retirement. 8 months later, 2 envelopes arrived, and both were IRS notices. One said she owed underpayment penalties she couldn't understand. The other questioned her Social Security income and threatened additional taxes too. Carol complied. She hid absolutely nothing. She was not gaming anything. She had just retired. Yet that single change, going from worker to retiree, turned the tax rules against her overnight. The rules didn't shift. They changed completely at once. Employer-run safeguards that had worked for 3 decades disappeared the day. Neither her employer nor the IRS sent a friendly note saying your tax world just changed completely today. Instead, deadlines and penalty language arrived in the mail, assuming she already knew the rules. In this video, I'll outline the exact 5 places the IRS scrutinizes you harder the moment you stop working entirely now. These 5 traps snare most retirees in their very first year when the paycheck ends. They are not small mistakes. They lead to surprise tax bills, quarterly penalties, bigger Medicare premiums 2 years later, and months spent answering IRS letters and forms alone. Whether you're already retired, nearing retirement, or helping aging parents through this switch, stay until the end, because Trap 5 by itself has silently cost certain retirees over $15,000 in 1 year, and almost nobody brings it up until after it's far too late for them to fix. Let's start. Intro 1330. This video is educational only. It is not personal tax advice or guidance. Speak with a qualified tax professional and review your facts before you act or decide. Carol spent 31 years working as an accountant. She knew the tax code well. She prepared returns for clients. She filed her own return every April and never had trouble. She retired June 2024 officially. By February 2025, she had 2 IRS notices, something she had never seen during her whole career before. One dealt with estimated tax penalties. The other flagged a withholding mismatch involving her Social Security benefits income. Neither notice was catastrophic, but each one cost her time and money, plus that special dread only IRS mail brings now. Carol didn't change her behavior after retiring. She filed the same way. The problem was the IRS moved the target without warning. The employee-era rules that shaped her taxes changed in ways she didn't notice the day her last paycheck hit her account at all. Her income sources were different. Her withholding setup looked different. Her reporting duties were different. And those 5 spots where the IRS pays the closest attention to retirement income are the same ones retirees rarely hear about ever. Today, I'll walk you through these 5 areas with examples, the exact forms, the deadlines to watch, and the penalties involved too. These are the traps that turn an easy retirement into stressful months, surprise bills, and baffling letters from IRS. If you just retired, you're about to retire, or you're helping parents who recently stopped working, this may save thousands of dollars and many hours of headaches for you. Even better, you'll learn what to set up before you file your first retirement return, so those IRS notices never appear in your mailbox in the first place. Let's jump in. Trap 1 is withholding disappearing automatically. 330-1030. The first shift you feel after retiring is withholding changes immediately. Back when you worked, your employer held back federal income tax each paycheck. You filled out a W-4 when you began that job. You chose a withholding level, and for the rest of your career, the process ran automatically quietly. Taxes came out before your money ever landed in your checking account. Most workers avoided huge April bills because withholding already paid much of what they owed steadily during the year, month after month. Once you retire, that payroll system stops cold. Your retirement money comes from several places, and none of them withhold automatically the way wages did for most people. Social Security allows optional withholding, but you must ask. IRA and 401k distributions have withholding choices, but you must select them at the time of withdrawal. Pensions require a separate W-4P form, and many retirees never submit it either. Dividends, interest, and capital gains usually arrive with zero withholding attached at all. Rent payments have no withholding. Consulting or self-employment income has none either. So many retirees reach their first filing season facing a large underpayment they never planned for anyway. And this part catches people off guard. The IRS wants taxes paid as income comes in during the year, not as one big April check from you later. If you short your taxes by over $1,000 across the year, the IRS can add an underpayment penalty on top of the tax due. In 2026, underpayment penalties start near 7% in quarter 1 and about 6% in quarter 2 for many taxpayers initially. Those rates change each quarter and accumulate on what you should have paid earlier instead. The safe harbor rule matters. Before I explain the fix, remember the IRS safe harbor rule, because this one guideline decides whether a penalty applies to your return or does not. The IRS will not assess an underpayment penalty if you satisfy either of two tests. First, you paid at least 90% of this year's total tax through withholding plus estimated payments put together already. Second, you paid 100% of last year's total tax amount due. If your previous AGI was above $150,000, the target rises to 110% instead. That's why, in your first retirement year, it's simplest to look back at last year's return first thing today. Locate line 24 for total tax, then make sure this year's withholding plus estimates add up to at least that figure before you file again. You might still owe when you file if income changed a lot, but you'll generally skip penalties that way. How to restore withholding in retirement properly. The fix is straightforward, yet very few retirees set it up automatically. For Social Security, submit Form W-4V to SSA to start federal withholding from your benefits checks. You may choose 7%, 10%, 12%, or 22%. For pensions, file a W-4P with the plan administrator to withhold at the right level for you. For IRA withdrawals, elect withholding whenever you take out a distribution. Many custodians automatically pick 10% or 20%. Confirm the percentage they're actually taking. For income with no withholding, dividends, interest, gains, rent, consulting, send estimated payments quarterly using Form 1040-ES to IRS on schedule. In 2026, the due dates are April 15th, June 15th, September 15th, and January 15th, 2027 exactly. Skip one quarter, and the IRS calculates underpayment separately for that period. The IRS doesn't smooth payments across the entire year out. Even if you pay it all in April, you can owe penalties for earlier quarters. The after-tax pension contribution trap here. Another withholding-related issue hits many government retirees and defined benefit pensioners, in particular at tax time. Lots of pensions contain some after-tax contributions you paid in. That slice of each check is your own money coming back, and it isn't taxable income. The IRS calls this the simplified method, sometimes called cost recovery rules. The worksheet appears in IRS publication 575. If your pension came from work where you made after-tax contributions, but you've been taxing the full payment, you may be overpaying every year without noticing at all so far. The IRS watches whether retirees compute that exclusion correctly each year. If you miss it either direction, you'll get an IRS notice. Real-world example now. Let me put real dollars on this example, so it feels concrete. Robert retired January 2026 too. His annual retirement income included $36,000 from Social Security, $24,000 from a pension, and $18,000 from IRA withdrawals overall too. Altogether, his income totaled $78,000. While employed, his employer withheld roughly $14,000 of federal income tax over the year for him. Robert set up no withholding on Social Security benefits. His pension withheld $2,000 using the default setting. He withdrew IRA money with no withholding. When Robert files in April, his federal tax comes to about $2,500 based on income and status that year. All year, only $2,000 was withheld total. He owes $8,500 at filing, plus underpayment penalties, because he never made quarterly estimated payments once. The penalty isn't enormous, but paired with that surprise $8,500 bill, it's a brutal shock on fixed income for many retirees. Robert made no errors, he violated no rules, he just failed to replace the withholding system his employer had handled automatically for him for 30 years. Trap 2 is that Social Security income gets watched closely. 10/30/1630. The next shift is how the IRS tracks your Social Security benefits today. Each January, you get Form SSA 1099 listing the total benefits you received last year. That form goes to you and to the IRS too. So before you file, the IRS already knows the exact Social Security amount you collected that year. What they watch most closely is whether you calculated the taxable share correctly and entered it accurately on Form 1040, line 6B, every time for them.